The market has finally pulled back, giving us a great opportunity to load up on some stocks that we've been watching. What's up, all my trader and investor homies out there? It's your boy Kevin from Touchdown Trades, your trading BFF, your stock market bestie. In today's video, we're going to be discussing my top 5 stocks currently trading under $20 per share. If you're new to the channel, this is Touchdown Trades. We talk about the hottest stocks in the market every single day, and we drop a few swing trading videos a week. So if you're into that type of thing, consider subscribing. These videos do take me a little while to make. I put hours into each of these videos. So all I ask for in return is a smash of the like button. Give the like button the old Touchdown Trades snake eye jab in the eyes. Some of these 5 companies trading under $20 a share are high growth stocks, while others are just flat out too cheap. So we have some real banger stocks that I'm going to be investing in here that we're going to be going over today. As retail investors, we love getting good deals on these cheaper priced stocks because these cheap stocks always seem to be the ones that do the best in our investing portfolios. Now that the market has finally dropped, it's time to brush off some of that cash we've had sitting on the sidelines and find some good deals on some cheap, low-priced companies. Let's secure the bag and let's get it. Trader and investor homies, let's talk about my top 5 stocks currently priced under $20 a share. Ticker number 1 is going to be JWN. Nordstrom is the company. I'm sure you guys are all familiar with Nordstrom, a big retail giant. And you may be saying to yourself, wait a second, Kevin, retail stocks, brick and mortar retail has been crushed over the last 5 or 10 years by the influx of e-commerce giants taking over the retail industry. But I actually believe that the Rhinoceros Rex doing Nordstrom a favor. Through all of this, all of their retail stores have had to get shut down, just like every other store out there. It went through a period where every store that Nordstrom owned was closed. Okay, and this has made retail realize that they don't need these big brick and mortar stores to be open. So Nordstrom can slash some of those failing stores, just shut them down altogether, stop some of the bleeding, and focus more on having an online presence. So close down the failing stores that aren't making you any money, keep some stores open, the stores that produce well, and start selling more online. And you're probably saying, well, Amazon's already got the online sector covered, right? So why would people go to Nordstrom and shop online when they can go to Amazon? Because Nordstrom is higher end. You're not going to go buy a Gucci purse on Amazon. You're not going to go buy your Ferragamo loafers on Amazon. You're not going to go buy your $100 bottle of cologne for a Christmas present on Amazon. You can go to Nordstrom, buy that high-end product, and have faith that if it doesn't fit or it isn't right, you can take it back to an in-store location, and that gives Nordstrom an edge versus its competitors. They need to focus on the higher-end products and let Amazon take the cheap Chinese manufactured stuff and just let them have it. Focus on your higher end customer and Nordstrom will be just fine. Let's take a look at the numbers here real quick. We have really good sales for Nordstrom, right? We have sales numbers of 12 billion last year. It's going to be lower this year due to the shutdown, due to the quarantine. But we're looking at really good sales number. We also lost a ton of money last year. We lost $500 million in this Nordstrom. But that's why they need to shut down the failing stores and focus on selling their higher end products online. And I think they can become a profitable business. Once again, we have a price to sale ratio that is ridiculously low at less than 0.5. So price to sales ratio is basically comparing the sales to the price of the stock, the market cap of the company. The sales of this Nordstrom are 5 times higher than the market cap. So the amount of sales that Nordstrom does in 1 year is 5 times as much as this company is worth right now. That is extremely low. Even for retail, that's low. And we have a forward price to earnings outlook of under 10, which is also good for retail. So I see this Nordstrom trading back again over $30 a share within the next year or so. So we're looking at 100% upside on this Nordstrom stock. I like the potential, and I like this as a growth story too. I know you think of a company that's been around for hundreds of years and you think it's just a value buy, but I think if they cut some failing stores and focus on their online presence, Nordstrom can grow again and become one of the biggest online retailers out there for higher end goods. So my plan with this is to start buying this thing on any pullbacks, and I'm looking for Nordstrom to make at least a 100% move back to $30 a share. So I'll be investing in this Nordstrom and looking for a big 100% move on this stock over the next year or so. That's ticker number one. Let's move on to the second one. The second top stock that I'm going to invest in that's currently under $20 a share is this CLDR Cloudera. So we all have been seeing all this hype over the Snowflake IPO. The next big cloud company, the next big data company. Everybody's been talking about Snowflake, and the price of Snowflake was supposed to be much cheaper than the initial IPO, what the price came out actually being, because the hype was just so high, the demand was so high, and the FOMO was real. So I started thinking to myself, wait a second, this Snowflake's trading at an extremely high valuation. It's gonna need like 100% growth over the next 5 years in order to fill that valuation, in order for that valuation to be realistic at all. Started thinking to myself, let's look for some more data companies and get into some of these cloud companies that are trading at a much better deal. So I found this CLDR and I really like the looks of this company. So this CLDR Cloudera is a cloud data company that is very similar to Snowflake, a little bit different, as Snowflake is, I believe, solely in the cloud, and Cloudera does offer some hybrid solutions. I'm not really smart enough to understand how the cloud data management stuff works, but I do know it is the future of tech. It is the future of big business. All big corporations are using data management companies, cloud data, and data is everything, right? If you have more data on your customer, you can sell to that customer better. Snowflake is currently trading at a valuation of like 100 times to price to sales ratio. So Cloudera is trading at a price to sales ratio of 4. So Cloudera is much cheaper compared to a company like Snowflake. We know big data is the future, so I'm looking to invest in this Cloudera. Sure, Snowflake's growth is going to be much higher and quicker than Cloudera, but Cloudera just came out with a new platform, and I don't believe the market has priced in that platform yet. We're looking at an expected growth of over 30% next year on this CLDR. So I think the growth potential is there, and we know this sector is the future. I'll be looking to buy and invest in this Cloudera, and I'm looking for this thing to make a move back over $20 a share, and we're currently trading right around 10 bucks. So another 100% move is what I'm looking for on this Cloudera. We're looking at cheap stocks because we're looking for big moves. And I would probably set my risk on this thing down here around the $6.50 area. So we're risking about $3.50 to make about $10. So the risk to reward ratio is on point. Let's move on to stock number 3. The next ticker is going to be CCL, Carnival Corp, Carnival Cruises. We've talked about this one in the past. I'm extremely high on Carnival Cruise because I just believe if you can buy this stock and just weather the storm, just get through the next couple years, you're getting it at such a steal, such a low price compared to where this thing will be trading at 5 years from now. Carnival has been crushed with the rest of the cruise and travel industry because of the Rhinoceros Rex, and the no sale order keeps getting extended. I believe the no sale order is supposed to be lifted in October, but if that doesn't happen and this drops, that's just going to give me a better opportunity to keep buying this at lower and lower prices because I know this Carnival has enough money on hand to weather the storm. CCL has over $8 a share of cash in the coffers just sitting around in order to weather this storm. Carnival is one of the biggest cruise liners in the industry. They are going to survive. Mark my words, this company will survive and it will get back to where it was pre-Rhinoceros Rex. So if you can just withstand the storm. Sure, this company may drop lower. It may go lower. It may not. We never know. Nobody knows what a stock or the overall market's going to do. If the no sale order is extended, sure, this could drop. But this company is going to survive, and it will get back to trading at the levels before the Rhinoceros Rex happened, before the shutdown happened. I'm going to be looking to buy the CCL, and I believe this thing has potential to easily get back to the $35 area in the next 3 years or so. It's currently trading at $15. So I'm looking to buy any dips on this CCL. I'll buy all the way down because I have that much faith that 5 years from now, this thing will be trading at $40, $45 a share, and that it'll be doing more business than it did before the shutdown happened. The next ticker we're going to talk about is BLNK, Blink Charging. I made a dedicated video about this company the other day. If you want to watch that video, I will link it up above in that info card right there. So we're just going to go over this real quick. Blink Charging is an EV charging company, and if you believe that EV is the future of the automotive industry like I do, then I believe you need to hold some of these EV charging companies in your portfolio. Think about the future of this. Everybody's just thinking about the car manufacturers themselves. But if 50% of the United States population is driving around in EV cars, then they need somewhere to stop and charge their car. There's going to be membership opportunities where you belong to like a Blink charging membership. You pull into your grocery store, you swipe a card, pay $3 or $4 and recharge your car while you're grocery shopping. The potential for these charging companies are huge. Check out this Blink. We'll go jump into the charts and I'll tell you what my plan is. But do your research. Check out the video that I did on this Blink charging. I'm looking to invest in this Blink on any pullback, and I'm looking for this thing to break all-time highs before I even consider selling. So I'm looking for another 100% move on this Blink stock. I'm going to be adding into any dip. So if it drops to 5, 4, I'll continue to add because I have faith in this company, and I'll add on the way down to average my cost basis to get a lower cost base. That's ticker number 4, BLNK. Let's move on to the fifth and final ticker. The fifth and final ticker is going to be this DOYU. DOYU Holdings is basically the Chinese version of Twitch. We are all familiar with Twitch, the online gaming streaming service where gamers will go stream and their viewers will watch them as they play the video games. We all know that Twitch is huge in the United States and its subscriber base keeps growing as gaming becomes more popular than it has been ever before. So I'm looking to get long this DOYU. I'm not really sure how to pronounce it, so if I'm butchering the name, don't come at me in the comment section. So I'm getting along this DOYU, looking for this to kind of build into the Chinese version of Twitch. This company is expected to grow exponentially over the next few years. Earnings per share have grown by over 100% this year. Earnings per share expected to grow by 45% next year and by about 35% over the next 5 years. So we're expecting massive amounts of growth in this company. So the same goes with this DOYU as with all the previous stocks. I'm going to be buying any dip in this company. The only difference between this company and the rest is that this company is trading. It's made a nice move to the upside. So I'm probably going to be waiting to hold off on this one until we get some pullbacks down towards like the $13 area or so. And then I'll look to get long as an investment for looking for this thing to head back up towards all-time highs. So that is my top 5 stocks that I'm looking to invest in right now that are trading under $20 a share. I hope you guys got something from the video. If you did, please do me a favor and smash the like button for me. I love all of you guys. If you're not yet a subscriber, what are you doing? Consider subscribing down below. Hit that notification bell, and I'll catch you guys in the next one. Peace.
Drop.